Good afternoon, everyone. Today we'll understand the setup of moving averages, which I always tell people to follow. Now, over here, I will just show you from 30th of May or 30th of May how we can easily trade just using moving average. So, I'm applying my indicator now, and in this indicator, I am removing everything first so that you can easily see it. Now there's nothing over here. I'm also removing the tables. So now we have an indicator which has not applied anything. So the first thing we'll apply is a Bollinger Band so that we understand the volatility of our stock. Currently we are observing Nifty. Now, how do we understand that it's actually a bullish market? So the first thing we are plotting is an EMA. When I say over here fixed EMA setup, it's actually the EMA 50, and then I'm also plotting the 50 SMA and 200 SMA. For our purpose, we'll remove the 50 SMA because we already have the EMA 50. So only three things. We have Bollinger because it will have a 20 SMA, a 200 SMA which is a higher moving average, and a EMA 50 for our intraday. Now if you carefully observe, whenever the candle is below the SMA, which is the yellow line, SMA 20, this curved line is EMA 50. I'll make it thick for you so that you can see it carefully. So the candle is below the yellow line, candle is below EMA 50, and candle is below the 200 moving average. If you notice, this is a proper bearish fall. Now when a bullish move comes, it will cross the SMA 20, 200 moving average and EMA 50, and the RSI will be above 50. This is a good time to enter. Now if you see, it has just fallen after that. But this fall is not to be considered unless it is falling down from all the averages, which is EMA 50, SMA 20, but it has not fallen from 200 SMA. We'll observe on the next week what happens if it falls below here. But I'll take you to some charts before that. So we'll go directly to April. Now if you see from April 1st, whenever the candle is above these three lines, that is 20 SMA, EMA 50 and 200 SMA, you can see a bullish move coming. And whenever they drop below these three lines, a bearish move comes. Now over here you see the move was very small and it came down. So here is where you need to protect yourself using a stop loss. So what is a good stop loss? Now that depends on your risk management. Somebody will take 20 SMA, somebody can take EMA 50, or somebody can take 200 SMA. Depends how you're building your position. But if you see a candle coming down from 200 SMA, you should quickly exit from any bullish position you are carrying. We're still in the bullish. You see 200 SMA is a resistance here. It's fallen further down. Further down. And then all of a sudden there's a bullish movement upside. But the next day it tried falling and quickly went up. Again, unless EMA 50 is not crossed, don't enter. See over here, it just came down from. So EMA 50 in intraday acts as a good resistance and support. See, it comes down again. Now see over here, it's above 20 SMA, above 55 EMA, but 200 is facing as resistance. Hence, all the candle needs to be above all three lines. This was a good setup to enter, but obviously your stop loss should be there, else you will get trapped. See the move that is coming again, a good big move, and then when it falls below 3, it's again a bearish sign. So I hope this helps you understand what I'm trying to say, that this is a very simple setup, time tested and trusted. Now I have made an algo on this which will explain you the same logic. If you see over here, my strategy is the low should be higher than 20 SMA and it should be higher than 50 because I'm doing only intraday, not position. My RSI should be above 55. My stop loss I'm giving 99 points, but target I'm taking as 60 points. My exit condition is if the high is lower than EMA 20, I will exit. Now over here I don't have EMA 20, so what I've taken is SMA 20. I can also add over here, there's one more EMA I have, and that's 20. So using these lines also you can understand on the future chart. Then my testing is on normal, I'm not doing MIS. Time entry is for full day. There are no cycles that I'm using. We can choose one if we only want to trade once, but I'm choosing n number of times and saving it. Now when I run it, you can see the back testing results. Let it come. So it's giving a 377% return only on one lot. I'll show you that as well. If you see, I have only taken one lot. So again testing it. Now when the results come, we need to see it very carefully. This is my profit and loss curve that is happening. If I would have put one lot, which would be around 10 to 15,000, over and above that I would have got 34,000 rupees. If I remove the brokerage, it comes to 31,000. So it's fair enough to pay 3 to 4,000 rupees brokerage. Now there were 55 signals, out of which 27 are win and 28 are loss. Now you may think there is a high number of loss, but trading is never without stop losses. One needs to remember that. But you need a setup in which when you earn very well, and when you lose very less. So if you see, my average loss is only 1,137, where my average gain is 2,461. Now why I am so comfortable with this is because when it wins, it gives me good number of returns. Here are the transaction details. If you see, entry, target achieved, entry, exit achieved. Means on my exit position it came out. Again entry, target achieved, again entry, target achieved. Now if you look on your left hand side, the dates are there and the time is there when it went in. So when you have an algo, you have no emotions and view. It will keep entering every time it finds the buy condition over there. So this was a short video to explain you why this strategy works every time, everywhere. If you have more questions, feel free to ask me. I'll be happy and glad to answer all. Thank you so much.